Okay, let me just wrap up this inventory discussion real quickly with a couple more slides. So we talked and looked a little bit about reasons why a company might pick one over the other. There were some other reasons that I should have mentioned. So with weighted average, you're going to get a nice smoothed out cost for your product. So it'll smooth out any possible price changes you have. First in, first out is, again, assuming we're in a period of rising prices. Ending inventory is going to better approximate current replacement cost, which is a good thing. But under LIFO, last in, first out, it's going to better match the current costs in the cost of goods sold. So our expenses against the revenues earned during that period. So there's benefits and disadvantages to each of these types of methods. Also, I should mention, so retail companies will use merchandise inventory, and that's what we talked about previously. But manufacturing firms are going to have three categories of inventory. They will have raw materials, work in process, and finished goods. So finished goods are ready to go out the door. They've been completely modified and are ready and available for sale. Raw materials are materials that come into the business that need something done to them in order to make them finished goods. So if we're building cars, raw materials might be tires and windshields and door handles and all those parts. Work in process is inventory that's been started but not yet completed. So we've started to assemble the car. It's partially completed, but it's still not complete enough to be moved into finished goods. So this is more under managerial accounting. You'll see when we start to cost for things, we'll have three buckets of where we put our inventory, those three. Couple of things too. Errors in the amount of ending inventory can have a direct dollar for dollar effect on cost of goods sold and net income. So for this reason, independent auditors and income tax auditors and financial analysts do look closely at reported inventory amounts. It's interesting if you've ever been through a large inventory, say at a large retailer, they will often find thousands and thousands of dollars that are either what they call shrink, meaning it's disappeared and we don't know what happened to it, or they also have swell, so we have more than we thought we actually have, and both are equally bad. And hopefully the thought is sometimes if we miscount something that we'll catch it in the next, not till the next year when we redo our inventory, but that it will balance out. But as I said, errors in inventory can have a huge effect because all of that shrink money, all that inventory that's gone missing for whatever reason, gets charged to your cost of goods sold, which is also going to reduce your net income. And one last thing concerning inventory here, a lower of cost or market. So inventory should be reported at what we call market value when market is lower than actual cost. So if you owned a bunch of iPhones and you have a bunch of iPhone 2s, obviously those are probably worth less now than they were when they were originally cost or purchased. So we would have to write down the cost of that inventory to either the lower of the cost or the market value, and that would be replacement cost for those particular items. So not necessarily sales price, but replacement cost for those items, and that's it's the conservatism principle. So we want to keep our financial statements conservative as possible. We don't want to overstate the value of our inventory. Thank you.